Good evening, ladies and gentlemen. Hope you're having a wonderful start to your weekend. Happy Saturday. And boy, oh boy, we got a question to answer today. A loaded one at that. Do we buy the dip or do we sell the rip? And there's some compelling evidence for both sides. And I'm going to give you my theory. I'm going to present the evidence to you guys. And basically, we'll just talk about it in the debate section of the video. All chapters in the video will be timestamped down below if you want to skip to anything that you just want to see particularly. And if you're new to the channel, welcome. Hope that you find this interesting. So without further ado, let's just dive in for the quick recap of what happened this week. So pretty much we open up on Monday. We kind of do a spinning top candle, which is a bearish candle. However, we were above the 456.43 value that we basically went over last week to be our bullish bearish indication. So we defended that pivot point, rotated, but then the next preceding day we were just hugging it. So we weren't really advancing. So whenever you see something like that where you're just hovering around this pivot point and you had this move up, you're hovering around this pivot point, you're expecting a bigger move from that. And we got that bigger move. We had the Finch downgrade that no one saw coming. And everyone's trying to play it off now of, oh, it's just no big deal. Finch just downgraded the U.S. debt, which increases our borrowing costs, and that's not going to have an impact. Instead, the Treasury has to buy trillions and trillions of dollars in debt now that they weren't expecting to pay now a premium on. So guess what? Yeah, it has a big impact, and everyone trying to play it off as nothing is kidding themselves. But before I digress, we basically went lower and lower and lower. There was no higher high this week. It was just sell, sell, and sell. Even though we got a bounce on the day, especially with the Amazon and Apple earnings, kind of uplifting the market, kind of giving more of a good vibe. We saw the jobs numbers, which we'll go over in a second here, of what they came out, and it just wasn't a good day. As if you look on the intraday for the previous day, we started off and basically it was just, the second 1 o'clock hit, boom, sell time. Just sold off the entire day with volume, with momentum. This was increased volume. If you look at the start of the day right here, we actually had significant selling volume going on during the day. So that was a pretty powerful move. And there's a couple of things that surprised me that I'm going to share with you guys, and we'll go from there. So, we broke above where the weekly range support was, but then failed break below it. So on the weekly graph, it's basically a failed breakout, or I shouldn't say failed breakout. It's a basic complete breakdown. Period. Simple double engulfing of 2 weeks. So we wiped out 2 weeks of gains in one single week, which is a proverbial thing of we take the staircase up, elevator down. Now, the question is, did the elevator stop? Did we finally hit the bottom floor? Or are we going lower? That's what we're going to be trying to answer today. But let's just quickly go to the news to see what was the catalyst during the week. So Monday, there wasn't really much except good old OPEC came out and basically said, yeah, we're going to be cutting production. And that's something no one's really talking about. Oil instantly goes up to $82 a barrel, no stop. And oil was pushing already up into the $80 from $62 about 2 weeks ago. So it was already on a move, and now it's going higher. And we're going to dive into that piece in the news section later in the video of where we're specifically talking about CPI, guys. CPI is coming this week, so that's going to be a very, very big news day. We got a couple things that we're going to discuss about that. But OPEC coming out, giving its a statement that, hey, we're going to extend the voluntary cuts, million barrels cut into September for the next month. So they're basically doing like the Fed. Hey, we'll do it meeting by meeting. So then we had ISM PMI. So that's bad. We're still in contraction territory for July. But yet people are saying there's going to be no recession. History tells you when you stay in a contraction this long, the economy is contracting. Therefore, lower growth, therefore GDP go down. And you can cook the GDP numbers as much as you want with government payrolls and government spending, but eventually you're going to have to pay the piper. And we're starting to see this. We got job openings, a decrease. We saw a decrease in the job jolts. The previous number was revised lower, and that's just bad. So are we seeing the boat start turning on these job numbers? And the proverbial boat is heading right for the iceberg called a recession, because you don't just start having this traditionally with jobs. You have ebbs and flows. You don't have consecutive decreases at an accelerating. So you're starting to accelerate. So now if we get the next months and they go back up, okay, throw the theory right out the window. but you're going to have to wait nearly 30 days from now to know what the job numbers are going to be for August when we get them in September. So, and that's going to be about Labor Day, so it's going to be a pretty massive time around then. It's going to be holidays, so you get a spike of volatility, but that's not good sign. Contraction, jobs going down, 2 strikes already. Then we go to ADP non-farm payrolls. This thing just absolutely crazy. Just stop paying attention to it, period, because these people obviously don't know how to calculate job numbers or anything in the realm of jobs because they're just all over the place. So that's all I'm going to say about ADP. Next chapter. Initial jobless claims came in line. So congratulations to the people that actually got this dang right for the first time and God knows how long. So services PMI, again, coming in below expectations. So just everything's looking at contraction. Factory orders were up a little bit, but they only up by 0.1% comparison. So you're heading into that bullish time for factory orders. It's March into August is that bullish time, basically where orders spike up on the factory side, and then they calm down going into the quarter 3, quarter 4 of the year. And then again, ISM non-manufacturing, contraction, again, barely avoiding contraction territory. It's just nothing here screams, hey, ultimate bull run coming. And then again, reserve balances with the Federal Reserve balances increased about 0.1 trillion. And then the creme de la creme, as I would say, on Friday, we had average hourly earnings, which this blew my mind. So why did it blow my mind? You have the current job. So this is the job market's still hot, right? These numbers actually don't show that labor is calming down because employers are still paying more per employee and have to retain those employees. But now they're starting to cut the jobs, and then they know that they still have jobs out there. It's just this weird dynamic of you're still earning more per job because there's still a proverbial tight labor market, and unemployment ticked down to 3.5, but there's less payrolls, which those two things really shouldn't exist in the same realm. But could this be, like I just mentioned, the ebbs and flows of the job market? Do we see another contraction? Do we start seeing hourly earnings go down? Do we see unemployment start ticking up? Like, remember, the Fed's forecasting 4.5% unemployment by the end of this year. So we got a nice long proverbial drop off the cliff coming if they're right. Now, they could be completely wrong. And non-farm payrolls, you are getting back to that 150 to 100. So now, once we cross that 120 barrier, I'm going to say that's when you start getting massive alarm bells going off. This is the warning signs compounded with everything else that we've been talking on the channel: inverted yield curve, commercial real estate, no bank-wide such, bank failures, all this. It's very reminiscent of 08, where it was you had the bank failures, you then had 6 months, which 6 months would be September, since SVB, and that's when you had your Lehman moment. 6 months later, Bear Stearns went, and everything was really calm in between. Everyone thought, hey, new bull market, everything's fine, a one-off. Same thing they're doing here. So I'm not saying that necessarily we're going to get that, but history tends to repeat itself, and now you're starting to see warning signs. The little cracks are forming that you're wondering, okay, is it just a stress crack or is it an actual crack? So again, we have to see how it all plays out. And then this baffled me even more of the net speculative positions actually decreasing from their previous. So market went down and decreasing, which the way I can explain it is, hey, they wanted to recoup the leverage that they were putting on. So it's really weird, like they're playing it smart when their team is necessarily per se winning. However, they're maybe making some of that losses back that they basically got handed to them on the way up. So they're trying to be smart about it. Now, that decrease is only 30,000, so it's not a huge decrease, or basically it's explainable if we go back to the S&P. They put it on going into this week, and then when it came back down, so they're making a small profit. So maybe they just want to deleverage, de-risk, which puts less bear fuel in the market. So therefore, if you get the true downturn, you get a true selling pressure, that's going to be bull selling. It's not necessarily bears, and then bears can reload those shorts if they want to. So it's more proper risk management than the bulls are exerting here. So it's going to be really, really interesting of how this all plays out, because they're going in the direction they want, but they're not necessarily taking advantage of it too much. They're not literally leveraging up to the eyeballs to then do like what they did here at 404k positions, where they were just going all ham into the market. So it's an interesting question. We're going to have to watch this pretty carefully going into the next month, going into CPI. Maybe they're holding off for CPI. Maybe they want to show like a weak hand when they're strong, go into CPI and then knock it out of the park. So again, CPI is going to be a huge discussion piece. If you guys want to skip to the end of the video, the debate section, timestamp down below. And with that, we're actually going to dive into the biggest winners and losers, and Fatal is going to give you that.
So this week was pretty crazy. A lot of news happened. In addition to, of course, the earnings, we also had payrolls come out. And the markets did not necessarily like it. You can see right here, the S&P 500 fell 2.44% on the 5-day, and man, on Friday it really did look like this thing was going up, and then at around 1 p.m. it decided to crash completely, ending the day on 4,478 points. Now, again, we did have a lot of earnings this week. In fact, a few notable ones were, of course, AMD on Tuesday. We got Starbucks, Caterpillar, Pfizer, Apple was a big one on Thursday, as well as Amazon, and we definitely covered Bud Light to an extreme amount, right? Shopify on Wednesday, Qualcomm, Generac, PayPal, all of these companies had a major impact on pretty much the whole earnings season. And well, let's just say that again, with the S&P 500 falling 2.44%, even though some of them did beat by a significant margin, like for example Amazon, other ones like Apple didn't do so hot. So let's jump now into the heat map for the S&P 500. As you can see, this thing is blood red. Only a few companies were in the green, and of course the notable one is this one right here. Man, that's something I was not expecting. Now, looking into the technology sector, worst performer here would be the company. I honestly thought, guys, it was going to be Solar Edge. It's not. It's Fortinet. Fortinet fell 26%. We really need to take a look at this one because this is major news. They lost this essentially after their earnings, so we really have to take a look at this. But also another notable one is, again, Solar Edge losing almost 23%. Companies like Apple, this was a huge surprise. 7.07%, and other companies, as you guys can see over here, like actually every single time I do this I find a new major loss one. So sorry guys, worst performer is the company DXY, losing 30.25%. Look at that drop right there. I don't even know about this company. I've never seen it before. So yeah, this one by far was the worst performer, unless I find another one in the next 5 seconds or so. Nonetheless, though, the best performer would be the company Anet, Arista Networks, gaining 19%. Looking now into the communications sector, worst performer here would be the company EA, losing 11%, and the best performer would be Warner Bros. Discovery. But look at this, Google dropped 3.36, Meta fell 4.53. We got over here, Match losing 3.88. We got Take-Two Interactives losing 6.21. So a lot of red here. Again, best performer was, of course, Warner Bros. Discovery. Looking now into the consumer defensives, everything here was massively in the red, all except for a few companies. In fact, I'm going to name them all. We got Bungie gaining 5.86, Kroger gaining 2, Clorox gaining 6.58, and I believe Colgate gaining only 0.85%. That's it, guys. From what I'm looking at, those were the best ones. Now, those were just the best performers. The worst performer, by the looks of it, would be the company TAP, Molson Coors Beverage, losing 7.43%. And I guess this is off the back of Bud Light gaining 7% in revenue. So again, they probably felt because of this. You know, people thought that Bud Light was going to crash. And I mean, we did the live stream and one person thought that was going to fall like 15%, and it didn't. So yeah, that's definitely something to note there. But as you can see, the consumer defensives, very red overall. Now, the healthcare, this thing is once again massively in the red, all except for just a few companies. The worst performer here would be the company ResMed, RMD, losing 19.68%. And the best performer, by the looks of, I was going to think it was going to be Humana. No, it is the company DaVita, gaining 7.69%. The financials are actually holding steady. Worst performer here, is it this one? No, it's actually PayPal. I was right. Okay, PayPal losing 15.2%. Guys, PayPal, we covered their earnings, and the reason why this occurred is because apparently they saw a small decrease in accounts, right? That's about it. So is it worth 15% decrease? Again, we did cover this. We did do a discounted free cash flow approach as well as a TA approach. You guys could check that out in our live stream. Here on the channel. So yeah, looking now at the best performer though, by the looks of it, would be the company Azurant. AIZ gaining 6.39%. Looking now into the consumer cyclicals. Worst performer here, it is the company Norwegian Cruise Lines losing 16.67%. But also take a look at this. Expedia losing 14. We got CCL, Carnival Cruise losing 7.2. Lowe's lost 5. Oh my god, we got over here MGM losing 11.6. It was a really bloody sector. Now, I can't really tell though which one here was the best performer. I'm having a really hard time. But yeah, guys, it was none other than Amazon. Oh my god, their earnings was absolutely crazy. Again, we did cover this as well, so you guys can check that out. But they gained 5.57%. Actually, now that I'm looking at this, oh, I am so terribly sorry. The worst performer wasn't Norwegian Cruise Lines. It was Etsy, losing 18.11%. But yeah, guys, best performer was none other than Amazon, gaining a whopping 5.57%. Looking now into the industrials, this thing is also blood red. Only a few of them were in the green. Worst performer, by the looks of it, it is the company Generac, losing 24%. We wanted to cover this one on the live stream, but we just didn't really have time to. Now I'm actually curious to do it again, because this is a, oh man, this thing just completely crashed. I mean, I really would like to see what the peak was after that massive rise that we see right there. Now, best performer, it is the company GPN, gaining 12.64%. In the real estate, this is actually a little bit mixed, more leaning to the downside though. We can see here that, of course, realty income is under $60. Again, guys, it is time to buy more realty income. Now, when it comes to the worst performer, would be the company EXR, losing 10.75%. Best performer, it is none other than the company Boston Properties, gaining almost 4%. But again, it's mixed, but definitely leaning more to the downside. The utilities, everything here. Whoa, I didn't even realize that. I did not even realize that the utilities did this bad this week. There's only one good one. There's only one that gained. That's so crazy. Worst performer, though, it is the company. Oh man, this is gonna be really difficult to find, isn't it? I actually think I just found it. I think it's the company, yeah, AES, losing 9.5%. But take a look at this, guys. NEE is under $70. Oh, okay. This one, oh, it may be time to buy NEE. Southern Company is under, Southern Company is 67. Okay, this is looking really good right here, guys. Look at this, Dominion. We were going to cover Dominion, though I couldn't because we didn't have the live stream. But this is another one that we may want to cover. $49, losing 8.02%. Wow. We definitely have to take a look at the utilities because this is looking good. Best performer, though, was the company Constellation Energy Corporation, gaining 8.56%. Now, if you all have seen gas prices, in fact, we're going to cover this when we talk in the debate, guys. Gas prices have been rising massively, and I'm actually surprised that this isn't greener. But we can see here that when it comes to the energy sector, the worst performer was Devon Energy, losing 4.15. Best performer, it's pretty close between the company Marathon Petroleum, gaining 4.64, and the best one being Pioneer Natural Resources Company, gaining 4.77%. And lastly, when it comes into the basic materials, everything here is massively in the red, or at least almost all of them. Worst performer, it is none other than the company, yeah, I believe this is the company APD. Wow, $284, losing 6.26, and the best performer, there's only 3 ones that gained, so I guess I'm just going to say them. MLM gaining 1.59, VMC gaining 2.64, and MOS gaining 2.54. So the best performer was the company VMC. Very red market this week, guys. Absolute insanity. And next week we have CPI, so that's going to be very fun to see. So with that said, Mike, take it away.
All right, guys. So for the key levels on the market, this is actually going to be a really fun one this week because I haven't had one in a while where we actually got to talk about a failed breakdown where we didn't just go straight up, and up. And the volume was actually nice. Like we started to see increasing bearish volume, more bearish volume than bullish volume. So, hey, are the freaking bears back in town finally, or is this just a fade out like we had before? And another thing, we finally started filling gaps, because I am so sick and tired of seeing 50,000 gaps on the market. It just drives me absolutely nuts. I hate gaps on any chart. It's just, I hate this gap up here. So now I'm thinking, okay, well, I got a gap below, gap below. So I'm stuck in the Russian roulette game of which gap I'm going to fill in next week. I think we're going to fill the bullish gap, and I'll tell you guys why. So the next speculative positions, the market's affinity for running up, it really puts a damper, let's say, on any bullish momentum, any bearish momentum that we basically have in the market. If we look at the weekly, we have a pretty massive range. And I'm going to say the pivot point, which is going to be that 451.55 level, is the bottom of the previous week. So that's where we broke. So that's going to be the areas that I'm going to be paying attention to. Support's going to basically be the low of the week. I do think if you get a pierce down of that level and then retrace back up, you get the bullish pivot. That's what I'm going to be looking for the bullish pivot. So something of the nature, let's say we even open up down here. We double bottom around the 445, let's say, and we open and then we push from there, right? Or we open near this break point, we break it, hit down to form a support area over this gap here, and then we rotate higher. That's what the bullish play would look like, in my opinion. Or here's your bearish for all those bears out there. You just send through this gap and basically keep going, like as simple as I can make it. And your target, once you break this gap, is going to be your 50 DMA. That which we have not tested in God knows how long, which actually, let's take a look at it. Let's take a look at when's the last time we touched the 50 DMA. Oh, here, when we broke above it in March. So you haven't had a retest. You haven't had all these things that are giving you bullish momentum in the market. And here's the thing that I've been banging my head over like a wall at this point. And that is, you have a straight line move up with decreasing volume. Guys, simple technicals, price and volume have to go up together or go down together. You don't want to have a divergence like that. It's just, I can't be bullish on this market with these things, because yes, I will take advantage of the bullish run, and I'm gonna probably buy the dip at the 50 if we go down there, or if the, like I said just a minute ago about the pierce and rotate up, then I'll have some confidence. And then you really start getting bullish once you get above 450 again, because that's a nice rotation to the upside. Because if you consider this to be an A to B move, where your A to B leg, B to C, and let's say we pierce down to the double bottom like I'm playing that theory out, that would push us up to 467.30, which would be our double top all-time high. Now, I'm going to show you guys a little thing in a moment, or actually I'm going to save that for the debate section. So you guys are going to have to go to there, because I want Fatal's reaction to it as well. So you're going to have to wait for that there. But again, the week 446.27, and I'd be expecting a pierce down rotation of it back to the upside and maybe filling this gap. Remember, if CPI if we're near this gap going into CPI, I definitely could see that rip up through that gap or gap above it, where we've seen before, where we basically get, hey, we push up and then we close the day here, CPI comes out, and basically, you know, we close here, right? So we got a candle right here, for example, we got another candle here, pardon the bad drawing, and basically we just open right here and just to the moon. So, you know, that's what I'd be looking at for that bullish play. That's going to be the bullish play, fill that gap, or even double gap, right? So you rotate higher, similarly how we basically had, I'm trying to find it, it was a moment ago, that there was a double gap on here somewhere. I have to look back in history, but oh, here. So you got a gap right here, so we jump above it, but then you rotate back down later, and it's a pretty bearish pattern longer term, but bullish pattern short term. So again, there's your scenarios that I'm giving you that you can play out. Now, for the bearish scenario is basically, I'm going to snap a line of importance to this gap right here. Once you start going and close below that, your 50 DMA is your target. That's basically, hey, take that short scalp position. Let's say you catch it right around halfway through the gap. We go down to the DMA. That's 1%, easy money. Make your 1%, move on. Quick scalp trade right there. That's how I'm going to be looking to play it, and that's how I'm actively going to be playing it. Now, again, you get the bullish rotation. This 458 value is probably going to get blown out easily. You got the catalyst in CPI coming up, and then we'll see also what other catalysts we have. But enough rambling about the S&P. Let's jump over to tech, because I know a lot of you like to trade the tech sector. So again, we had a consolidation, and now we have a breakdown of it. We rejected basically off our 21 moving average, which is I use it as a kind of like trend, market trend determination. You're above it, bullish, bearish, below it. So you're overall trending. So you filled a gap again. So congratulations, market. You filled a gap. You stopped making me lose my mind, partially. So we go here. We're very close to similar to the S&P. So let's just get rid of all these lines that we previously had. Let's go to the weekly view and do the same exercise. Bottom, top, and then let's see rotation on the week. And we're going to actually make all these colors good for you guys so you guys can clearly see. That's going to, that's going to be your bullish. No, sorry, red. That's going to be your green. And basically, let's see how the day looks. So, okay, similar to S&P, but the NASDAQ actually will probably sniff out if we're going to rotate bullish or bearish sooner than the S&P, just because its importance line is lower than the S&P. If we go back to the S&P real quick, you see it has a little bit of room it still has to go. That's approximately, let's say, 1.2% versus NASDAQ. Remember, NASDAQ has a bigger tendency to run, so this percentage should be bigger. Is actually just 0.74. So the NASDAQ is probably going to sniff out the bullishness versus the S&P, and tech is a more risk sensitive sector, or basically if people are investing in the NASDAQ, they're putting on more risk. So again, same conclusion like the S&P is if we start coming down to this gap right here and we basically pivot off of it, then I'd be looking to the upside, close above the support line, and start looking for that pivot attack and then heading higher, trying to fill this gap up here and possibly going higher. You got the catalyst for it. So pivoting point for the drop down, push up 370 on the dot, and then the rotation above 371.53 is where I could be looking to start opening a bullish position. And if we're looking like we're close there, my risk to reward is pretty solid there. And then pivot to where you go completely bullish, 374.34, and then you got a nice long run to 384.88. In my opinion, the reward is skewed to the upside if you get that play. Now, again, if you get that play and you don't just get sending right to the 50 DMA, that complete the gap fill, 50 DMA bounce, and that's where it gets interesting. I can't tell you what's going to happen once we get to the 50 DMA. Do we get a bounce? That's what I'd be looking for the bulls. If you crash right through that 50 DMA, oh boy, you got a lot of price structure that's not going to support you in any way, shape, or form. Going back to a parabolic correction, which if we consider this a parabolic correction, this move would basically be, let's say, 70%, bring us back down to the 330s, which would be a nasty, nasty haircut on the NASDAQ, which would be about 11% drop. So we've been talking about 10% correction in the market. So we just have to keep an eye on that and, you know, play it as it is. You got a lot of separation between your moving averages and long-term trend. So your 50 is really, really important, and you're very close to it. So we're going to have to see. And CPI, I think, is going to be the key determining factor. So make sure you guys stay tuned for the debate section where we're going to be pounding CPI, discussing it, giving you our full assessment of that, and basically just talking about all the things that are feeding into that. It's going to be a really fun debate today. So with that, guys, let's just jump over to the standard VIX dollar and yields just to talk about that, and then we'll jump over to the next section, which will be the news. So if you want to skip to any part, timestamp down below like I mentioned. So starting off with VIX. VIX had a nice pop. I basically warned you guys about this, that when VIX consolidates sideways, it has a tendency to pop. Usually VIX stops going down, then you go sideways, then you go up. It's just kind of how stocks work, you know? So we had closed strong on VIX for the week, and we just headed higher. So it was a pretty nice VIX play. If you played this to the upside, congratulations, you're above the 50. So that's bullish for VIX. You're starting to be bullish again. Bad for the market. But again, VIX could come back down to the 50. I do suspect that if you get that more bullish sentiment in the market, and we're going to have to see in the news section what could cause that. So pay attention to VIX. Let's see if it breaks back down below the 1440 level, and then let's see if we maybe get a trend line retest, especially if CPI comes in and knocks it out of the park, especially with oil basically doing what oil's doing. yeah, that would be a pretty good sign for the Fed, and the Fed most likely would not raise rates in the next meeting, or will they? So next, let's take a look at the dollar. So dollar, shockingly, we had some people comment on the channel. I even commented about those comments that, hey, the 101 retest, I definitely could see that and rotate back down. We were starting, and then dollar said, nope, I'm powering up. I'm trying to get above my 50 DMA. Failed to do that, so now do you get the rotation to the downside? So the rotation to the downside, let's see, would be A to B, B to C, projecting you down to $98.84. So now, again, I mentioned this when I was talking about that. I do see us coming back down to the 200 weekly on the dollar. That's where the dollar sat for so long, held at 98, 96 area. So it's going to be a big support down there. Again, with the Finch downgrade, it actually made the dollar stronger, which was a very weird, very convoluted assessment. But hey, I don't make the rules. I just follow the charts. So dollar going higher, or are you going to have a smaller A to B pattern basically here that completes up? Well, we completed that one. So now is this setting up the next leg to go A, B, C, D? We have to see. We have to see how the dollar, again, I think CPI, I'm beating a dead horse with CPI here, is going to be a big pivoting point for that to determine bullish or bearish. And last but not least, my favorite subject, which is yields. If we go to the short-term yields, we basically look 1 month, 3 month, and 6 month, all stagnant. And actually, let's take a look at the 10-year. So the 10-year just had a murderous day, breaking to basically new 52-week highs, roughly. Yeah, that'd be new 52-week highs, and then sold off. So again, this is a pretty strong move. Pullback is necessary. So if the 10-year keeps pushing, well, that means more pain and suffering ahead on the horizon. If we basically get a retracement down to about the 3.8 level, then okay, that's going to kind of calm down. We may avoid skipping recession going right to depression if the 10-year keeps pounding up higher. Or if it goes lower, we'll avoid that. If you pound up higher, you're pretty much guaranteed a recession at that point. But most importantly, let's jump over to my favorite thing, which is the yield curve. Again, we are heading towards the yellow line. The yellow line is the inversion of 08. Orange is where I'd be looking for basically the my theory to play out with the double top on this. So we have to just see how it all plays out. As you can see here, there's basically been stagnant. 2-year versus the Fed funds rate kind of trending. So the 2-year is actually still saying that the Fed's got one more last rate hike in them. And we just have to see how it all, or correction, the Fed fund rate saying, hey, we're higher. 2 years calling BS. So we have to see if this gets repriced. So with that, guys, this yield curve inversion, once we start basically coming back down to basically a 0.5% inversion, that's when we're really going to start seeing things break. Right now, I do expect stagnation in this like we've seen historically, but I could be completely wrong. I will keep you up to date as much as possible on this inversion and basically what it's doing. But this is going to be a pretty painful uninversion if you catch my drift. And with that, let's jump over the news that I've been basically ranting about for the last 20 minutes. So going into Monday, basically we got Harkin, Bowman, 2 Fed members talking. I don't think they're going to give you anything that you haven't heard. They're going to basically walk the line like every Fed member is. It's just a broken record. Tape record yourself, reverse play, reverse play. So we have consumer credit coming out as well. That's expected to go up again. So, that's going to be a fun one. More debt for consumers. On Tuesday, we really don't have much. We have imports, exports, small business optimism. I don't think they're very optimistic. And the AP Weekly crude report. So nothing here going to move us much. Then Wednesday, we basically have nothing. So it's kind of a boring lull week where this is where I'm saying the bulls can have control because there's no news catalyst. There's not really something to excite the bears. So they may be waiting till Thursday, which we get the CPI report. And now here is the fun part. I'm going to give you the quick rundown on CPI, and then we're going to talk about this in the debate section, so I don't want to repeat myself 7 times for you guys. This is pretty interesting. They're expecting 0.2 stagnation on the monthly, the year over year to basically go down 0.1%. But guys, I thought we were having progress on this. Oh well. And then CPI month over month, so this is not the core, is expected to stay flat, and then they have not published the year over number. I wonder why. Could it be that it's going up? Hint, hint, nudge, nudge. And then initial jobless claims as well. So we're going to have a jam-packed news, and we get the Fed balance and budget again on that same day. So nothing really big there. Now, if we look to PPI, which may be giving us indication what core is going to do, or CPI core is going to do, core PPI is expected to increase year over year, not printed. Something's fishy here. And then PPI regular, month of run, not published, or year over year number not published. I wonder why they're not publishing the numbers that's supposed to be coming good. I wonder why. But anyway, I digress. Then we got the net speculative positions on Friday. So it's going to be a jam-packed week. And without further ado, guys, let's start talking about CPI. Why do you, because I just hinted at this, why do you think they didn't publish CPI? Like, what does and publish core? What does core contain, or I should say not contain, that CPI does?
Well, I'm not really certain for the answer to that, but it's very, very, I don't know. That's weird, because you would expect, I mean, CPI has been falling at what, 1% every month for the past 2 months or something like that?
The bulls have been flaunting it like no tomorrow. Like, look, the Fed's gonna soft land, all this, like, all this bravado. And I'm like, what's the one thing that CPI was famous for having that now went down, that no longer is going down, that is now possibly going to drag this thing to the moon again?
Gasoline here in PA is $3.99.
I'm so not joking. They did it. They're like, well, we can't say $4 because then it's gonna have headline news, right? So it's like $3.99.99.
Yeah,
it's like $3.99.99. If you pull up to a gas station, because they give you like the tenth of a cent value, it's like 90. I'm like, you smug sons of you know what, and I'm like,
And then also, like this past, on Friday, crude oil gained 1.34. The current share price of crude is 82. Now,
82
this
and a half,
is,
good sir.
What was it?
82 and a half.
$82.64, the way from what I'm looking at here. But this is crazy, because I mean, the highest that we have seen crude was at what, like 120? And what was gas?
So when we were back at Looneyville, this is what I'm calling Looneyville, we were going to a $5 nation average. Whereas, so here's the weird part, right? So, like, you were in the fours, like here, about, right? So, July, September, we were in the fours when we were at, like, $96 a barrel. And now you're 82 and you're $4. So, it's like... and the reason is it's future forecasting, right? OPEC has basically come out, and I got the article right here, of Saudi Arabia to extend voluntary 1 million barrel per day crude oil production cut into September. So they're basically saying, like, we told you, here's the proverbial line in the sand, right? So they basically came out and said, here is the line in the sand. And you basically took that line, stomped on it, violated it. So now we're going to pull out the hammer and make sure you suffer. Because we want, and they've openly said it, they want 80 to above 80 is the line in the sand, and they want 100 barrel crude. They make huge profits. They're comfortable there. 80 is their line in the sand. And what the big elephant in the room that no one's really talking about, and I just thought of it, what caused this?
The fact that the United States was releasing oil reserves pretty much on a monthly basis,
and you got Zippo now,
and you got
Zippo and a pissed off Saudi Arabia.
I wouldn't necessarily say zero, but pretty much near all-time lows, right? Pretty much near all-time lows.
Yeah, you can't keep pumping. You can't keep pumping out of the reserve, because if you do, you're basically going to put the country in a position that, like, hey, if something bad happens, this is going to be like a like Bush carpetbagging FEMA. That level of, oh, crap.
So I just took a look at the AAA gas prices. If you want, you can just look this up real quick.
Sure.
Nationwide, $3.83. All right, $3.83. That's and by the way, that's as of today, August 5th. So, yeah, this is, lucky for you, good sir, North Carolina is still looking very, very good.
You mean South Carolina?
Not North Carolina, South Carolina, my bad.
Yeah, I'm in the blue.
Tennessee's looking good too. Pennsylvania, not so much.
Pennsylvania, hey, you're only that gas station's only charging you a tenth of a cent, 10 cents more than the state average, but
Yeah, it's absolutely crazy.
You
So,
could be in California and be $5 a barrel.
I mean,
It's
dude, look at
$5.
look at that West Coast. Look at that West Coast, and even like Midwest too, like Nevada. I kind of understand the Midwest states over here. Actually, I kind of, well, because I was gonna say like
They're in the middle of
like,
nowhere, literally.
Right, but then look at Kansas. Look at look at Nebraska. Like those states are in the middle of nowhere too. But I guess you could say Texas pipelines maybe go upwards to those states. Maybe.
Well, I would
don't really know
argue
the pipelines.
there's not a lot of infrastructure here. Like, I would say this. Well, then it
You're
depends on the
telling me
state.
they have infrastructure in North Dakota and South Dakota?
Well, I don't know. I don't understand the geopolitics of the state. I don't understand their gas taxes. So I'm not going to speculate. All I know is that I live in a nice blue state right here where I got $3.50 gas and I'm happy.
Man.
And it still hurts now.
It hurts a lot.
Because we were at $2 before.
Just a few weeks ago, I was at $3.55. All right, literally on Friday, I went to work. Gas prices were $3.89. I come back 8 hours later, $3.99. I'm like, this is deja vu. Oh my god, I remember this like what 2 years ago?
No,
it was the exact same thing.
It's not deja vu. It's not deja vu. We talked about this. We said eventually you're going to run out of bullets. And the other juggernaut that's sitting across the ocean over there is sitting on a freaking stockpile of ammunition. And all they have to do is wait. They have to wait you out. What does Warren Buffett say? The stock market, or anything in investing, right, is the transfer of wealth from the impatient to the patient. Saudi Arabia and OPEC were patient. They basically said, okay, United States, we're going to cut a little. We're going to bleed you dry. Literally, bleed the strategic oil reserve dry. So you basically had to dump your entire strategic oil reserve to get this decrease. And all Saudi Arabia had to do to literally, Saudi Arabia whispered 1 month extra, and oil goes and bombs from literally 20% up. What do you think they're gonna
bombs would be come down? But
yeah, sorry, rocket ships, rocket ships to the moon, whatever, to the moon emoji you want to throw down in here. It literally, they were like, okay, so now you have no oil, you have no ability to keep pumping, you have no domestic production. And now we have a world that's like hyperventilating on oil, as I would say. Like everyone's trying to get a stranglehold on it because you got so much demand that's out there. And they're basically going to be like, hey, we're the only game in town. So we control the supply. You don't get a seat at the table. They can make this price whatever they want. They can literally come out and say, now, they're not going to shock the system because they understand economics. They're actually smart, case in point of what they did. They're just going to keep, any time that oil fluctuates below, let's say, the $80 mark or is on the downtrend, they're just going to be like a production cut.
Okay, this is a financial channel, obviously. But what I'm about to say, it's mainly with geopolitics, but it does strictly correlate to this. How about the fact that the BRICS nations are like trying to get rid of the petrodollar by wanting to make agreements within themselves so that way they don't have to buy oil in the US dollar?
Well, it's because they're good capitalists. They literally they don't want to play the rigged game where they're determined by a crazy Federal Reserve that wants to hyperinflate the currency to then have periods of time where they have such a hard time getting dollars. Like, you think Saudi Arabia wants to pay it was nice and dandy until the Federal Reserve basically went on a interest rate hiking binge to make their life living hell, and they're basically sitting there saying, why on earth would we want this?
But to be fair, I guess a lot of people could say, yeah, but they're increasing interest rates to stop inflation. Right, but they were the ones that caused inflation to begin with by lowering interest rates to near zero in 2020.
Yep. And remember, as you increase interest rates, it makes dollars harder to get. So you're telling this oil conglomerate that is basically it's run in dollars. It's not in the United States. It doesn't have the
ability to print. The ability to print dollars.
Yeah, it can't go to the Federal Reserve and say, hey, I need money. It's not like a JP Morgan that goes knocks on the door and say, give me money. It's a third party, basically, in a different country, in a different side of the world that has completely different rules. and you're making their life more difficult, and you don't expect them to return it in kind to you.
Right.
It's not even politics. It's just pure survival instinct.
It's pure. Also, here's something else too. This is why controlling supply is so dang important, right?
Yep.
Because when you control the supply, over here we're definitely controlling demand, right? In the United States, we control demand, but demand doesn't drive prices, right? I mean, it does in a way, but what really drives prices is supply.
It's
right?
very
supply side.
It's
right.
very hard to control demand. It's very easy to control supply.
No. It's impossible to control demand because you always want more, right?
Yeah.
Demand is unlimited. Supply isn't. So if supply is the limiting factor, right? The like in chemistry, you're only as fast as your slowest reaction. Great. So if the supply is the limiting factor, you have to control supply in order to control prices. That's the thing. That's supply side economics, right? That's the complete opposite of modern monetary theory, which just says, oh no, just make more money and stimulate because prices are determined from the velocity of money, not necessarily the supply of money. So supply side economics is what drives prices. That's Austrian economics as well, and that is the actual true economics. None of this print more money today or make more money today or whatever the Fed does, right?
Yep.
But adding to that, why doesn't the United States? So take it back a step. There is a way for the United States to take control of this. You know what it is?
Pump more oil.
Pump more freaking oil. That's it. Because if the United States pumps more oil, we don't give a damn what Saudi Arabia. What can they say? No, you need to stop. They can't control us here, right? They can't control us here. But we can't ask them to pump more oil because we can't control them over there. So the best way to lower prices when it comes to gas is really, really easy. Make more supply. Make more stuff. That's with everything, by the way. That's with everything. You want the prices of technology to come down. I mean, look at a laptop. Look at the laptop back in like the year 2000. How much did that cost?
Like 800,
right?
$500. Now you're in the thousands.
Well, no. A laptop back in like the year 2000, that cost
2000. Sorry, my bad.
Yeah, in the year 2000, that was like $5,000.
Yeah.
And the battery life was nothing. You couldn't even log into the internet, let alone Wi-Fi, right? Because there was no Wi-Fi back then. You had like the pinball machine. Remember that? The pinball machine as like an arcade game. And it cost like $5,000. Come now, 23 years later, you could buy a laptop 20 times more powerful than that of the year 2000, and it costs less. That is the basic supply and demand right there, where the better things get, the more technology expands, the natural inclination, it is deflation, right? It is deflation. But in order to get deflation, you need to get more stuff out there.
Yep.
So that's just my rant when it comes to that.
No,
if the United States wants oil prices to come down from the average of now 383, pump oil.
Yep.
That's it.
And while we're on the topic of oil, let's just do a little thing. Start of July, right? To end of August. That's a 17% increase.
We just started August.
Sorry, beginning of August. My bad. And a 17% increase in the month of July. When if we go into the CPI report, I covered this in the oil video. It was basically negative 27% for gasoline.
Oh.
So what do you think that number, when that number completely goes bonkers back to zero, where you have basically no decrease, and we covered this in the CPI videos we've done. Shelter's going up, food's going up. The only thing that was holding you below, holding inflation below water with the bubbles coming up was gas.
It was oil.
Now inflation got a knife and is now sticking it into your head possibly and getting right back up. So congratulations, you took your foot off the tiger's neck, and don't blame anyone, or I shouldn't say that. The United States shouldn't blame itself. It should blame itself. It shouldn't blame anyone else for putting itself in the situation it's in. And the Fed can basically say, oh, we think inflation's going down. Boy, you're about to lose your credibility if this number comes in bad.
So when does the Fed have their next FOMC meeting? Is it in September?
Yes, it's September 15th. It's a month and a week from now.
Okay, so here's the thing, right? The core CPI doesn't take into account energy. Let's just keep that 1,000, right? Which is just completely insane. So maybe that's why we're getting that small drop of 0.1%. The problem with that is, what about, I don't know, that's the problem, is that even if CPI comes up, if core CPI comes down, but then again, everything is relating on oil. So, okay, I'm going to take this back.
You took the words right out of my mouth.
Right. So even if energy comes up in the core CPI, you won't necessarily see that. However, everything else is relying on that, right? Because the transporting food relies on what? Trucks. Trucks rely on what? Diesel. So everything is relying on that. So indirectly, core CPI should come up.
Yep.
Right? Core CPI should come up after. Pretty much any form of transportation. I wouldn't even argue even electric, right? Because
because how do you
electricity requires oil.
Well,
or coal,
because you
in some sense.
use vacuum heating oil to make electricity most of the time. You don't have electricity plants that run unless you're running nuclear, but that's seldom rare in the United States. It's either coal or oil, vacuum heating oil, and basically refinery byproducts.
Yep.
So with all of that, I'm like, there's a reason they're not publishing this number, and I really want to see what the number is going to be during the week. So if you're going into Thursday and they still haven't published this number, I'm going to take a short position into CPI, because I'm like, you've been fed this pig in a poke of inflation's going down, and the only thing that was holding you below water again was oil, and you have no way of lowering it. So
above water, you mean? Above water.
Yeah, but basically, you are, for lack of a better term, screwed, because here's the dilemma, and this is the ultimate dilemma. You have the worst yield conversion in history. Yeah. You have one of the longest in history. You have a jobs market that is having hourly earnings, and we'll get to that in a second, going up. You have employment at all-time highs, unemployment going down.
Yep, by 0.1, yep.
And then let's top it all off. You have record-breaking inflation, the Fed hiking rates to 5%, which or 5.2 now, which hasn't happened for almost 4 decades. And they still haven't lowered inflation per se, right? They haven't gone to their target, and you're breaking the banking system.
And then and now add on top of that the fact that energy is going up.
Yeah, you're screwed. You're literally screwed in every way, shape, and form.
But you know what's funny about this? We were calling this when oil was dropping, and we were like, it's gonna go back up. It's gonna go back up.
Because you can't pump or release strategic oil reserves when you have none.
Well, what I was going to go at it was just we were saying that it was going to go back up, but we thought it was gonna be a lot earlier.
Oh yeah.
Right? Like, I thought this was gonna happen like last year, but it didn't. We were just late, but we were right.
Well, it's because it's supply and demand economics. You can fight supply and demand as much as you want until you can synthetically push the oil prices down. And I word to use synthetically purposely, because you synthetically suppressed it for political reasons. Let's just be frank about it. And wherever it's good or bad, right? It is what it is. You synthetically suppressed oil prices to get a result. Now, that doesn't absolve you of paying the consequences for every action. Every action has a equal and opposite reaction. So you lower oil prices, guess what? You've pissed off Saudi Arabia in the process, so there's your consequence of oil cuts. And because of those oil cuts, now you're probably going to have skyrocketing oil prices. And this may be the first time in history, ever, that you have a recession while oil is skyrocketing. Oh wait, that's called the Great Depression.
No. No, there was another time, I believe. Oh man, what was it? There was a huge thing. I forgot when it was. I think it was maybe during Kennedy or Nixon, where we had something similar to this. We did have something similar to this. I forgot the year, but it was essentially the creation, I think it was, of OPEC to begin with. Yeah, it was. I forget the year, but this already happened. In fact, it was a million times worse. I'm pretty sure people that lived through that time. I don't remember if it was the 70s or the 80s, but I do remember a time when that was a thing. So yeah,
probably the 80s, considering like skyrocketing energy.
Yeah.
But it's you basically have skyrocketing goods with if everyone's hoping for job numbers to go down, like. So you want people to go unemployed with higher oil prices? In what universe do you live in that this is a good idea? And speaking of,
hang on. So it was in 1979. We got oil prices began to rise rapidly in mid 1979, more than doubling between April 1979 to April 1980. According to one estimate, surging oil demand coming from a booming global economy and a sharp increase in precautionary demand was responsible for much of the increases in the cost of oil during the crisis. Yeah, so this already happened. The problem is that, well, actually, I guess the ratio would be the same. Yeah, is that it?
Well, that's the inflation of the 80s. So basically, that was the pre-shock to what happened going into Volcker.
Can you look up there the oil prices going back to 1979 and 1980?
I hope I can. Let's see.
Yeah,
I'm gonna go to the monthly view just so this.
Yeah, just so that way it's a lot easier.
Oh, this is gonna be fun. Yeah. You mean that gigantic?
Where I don't.
That's
1979.
Second. Hold on a second.
That's.
We're experiencing technical difficulties, but let's. I would do it. You want 79?
Yeah.
Wow. Okay. So,
is that it right there?
Yeah, I think.
That's 63, 64, 79.
70. Yeah.
Look at that. Look at that. That's it, right? Look at that. Look at that jump right there.
About 1,000%.
80s, right? 1,000%. 80, right?
Yeah, and again, this is when oil, because splits and how future contracts are. This is like accounting for inflation and everything. So oil basically went from like $3.66 a barrel to $39 a barrel. So 1,000% increase.
Yeah. So what we're seeing today is obviously not to that same extent. We are definitely seeing another form of an oil crisis, I guess you could say.
Yeah.
So
self-induced oil crisis.
I mean, it's always self-induced because it always has to do with the government always being like, no, you can't pump more oil. It's just like, so then you're going to have higher prices. It's always the thing.
But then we're going to release oil from the strategic oil reserve to suppress
to lower prices instead of just bringing it more up, whatever. So I guess let's cover real quick, I guess, the payrolls, because that was a huge thing that occurred also on Friday.
Yep. So we had average hour, like I covered it previously, our average hourly earnings 4.1%, expect 4.2. So basically just people are earning flat, right? They were expecting people's financial ability to go down. They gave the big middle finger to that estimation, and then you got non-farm payrolls actually decreased. So they revised the previous months downward.
No, it didn't.
They revised from 209 to 185, and then basically non-farm payrolls went, so kind of staying flat month over month for July, flatness to 187. Okay, so basically
it did beat. It beat from the it increased from last month. Okay, I get that they revised it, but it did go up.
Yeah, slightly.
It's still lower than expectations.
Yeah,
which it's kind of just heading nowhere, honestly.
Yes and no. So like you're starting to have a slowing in the labor market. Keyword having and not halved, because you don't know whether this is going to go up or going to go down. You don't see, like JP Morgan's warning by Jamie Dimon of, you haven't seen the full effects of tightening. And are you basically starting to see this as a crack, or this just a scuff mark? And I don't know. And I don't think anyone knows until you get maybe 1 or 2 more months of payroll numbers. Because the shocking thing that I said in the beginning part of the video is you have unemployment going down, jobless claims going down, but then payrolls aren't. So it's like where these two worlds can't exist at the same time. You can't have less unemployment but less jobs. It's like the two don't make sense, meaning something's either not catching up or lagging calculation or something, or something's horribly wrong in the system, and this is just the start of it.
Yeah, absolutely. And the one thing that really got me off guard was the unemployment. What?
Yeah.
That unemployment ticking down. Man, that was just completely crazy.
Not what the Fed wants to see.
Right, but the tick down wasn't really that much, from 0.6 to 0.5. Still, though, not in the direction that the Fed wanted. So you have stagnating hourly earnings, right? You have pretty much payroll staying roughly the same. Now, ADP said that it beat massively, right?
Okay, I think so. I said this in the beginning of the part when I covered the news. Sure. Take ADP, put it in a bucket, put our gasoline on it, and burn it. Stop looking at it. It's just they've had such a track record of screwing the number up that I'm just like, screw ADP. Just okay, no, it doesn't exist anymore, right? When they get their crap together, maybe we'll look at it.
Okay, that's fair. That's fair. But all in all, this is not, and also on top of that, the fact that GDP did actually do pretty good.
But that was bolstered by government payrolls, government spending, and government payrolls. So
right, but where I was getting at was, there is nothing here to tell the Fed stop. In fact, I would actually argue that there's more evidence to tell the Fed, no, you can't do 25. You got to go back to 50.
Well, if they start seeing, because remember, they're going to get 2 CPI reports prior to their meeting. They're going to get the one on Thursday and the next one. So if you see 2-month increase in CPI, Jerome Powell will literally be have PTSD from Volcker. He will literally be the one thing he's been trying to avoid this entire time. He's literally going to have PTSD and be like, oh no. Oh no! Oh no! 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 We're not. No! Just he's literally gonna have a heart attack.
Right.
So, and the thing is, if you look at what they're expecting from the Fed, a lot of people could be very wrong because they're expecting a pause. 25. And if you get that hook from left field of a hike, that's gonna hurt a lot.
And we have two months of numbers.
Yeah.
If this thing, we're going to see, guys, because this is going to be fun. So what? CPI is on Thursday. So that's going to be a fun one. I'm going to put a poll to see what you guys think CPI will be. And let's see if you guys get it right or not. But this is going to be fun. Honestly, it's going to be really fun. And get ready for a lot of market volatility. A lot of it. So, yeah, that's I mean, the S&P 500 this week fell on average, right? Fell around 2.44%. So what's going to happen next week? That's going to be fun. Any other things you want to talk about? I guess the fear and greed?
You mean the broken fear and greed index?
It's still at 60. Of course, it's 69. Yeah, man.
Hey, better than 82.
It's still not better though. It's a greed. It's we at least wanted it to be in a perfect world, neutral. In my world, that thing needs to be at like -5.
We just break the scale. Just come back over here to like 0.
Yeah. Just absolutely break the scale. But I'm really, and also you had companies, earnings this week was just crazy. You had Amazon gaining 10% yesterday and Apple losing like 4% as well.
Well, so funny, you had I knew I forgot something. Let's just quickly.
Oh, you forgot?
Amazon bearish candle, because we talked about this. I said, watch what Amazon does. Does it open and push, or does it basically fall flat on its face? And then the Grim Reaper, Apple, just said, nope.
Dude.
Apple just said, nope, no thank you, see ya, bye.
Dude, if Apple fall, I messaged my wife being like, Apple is falling. If this thing falls anymore, I need you to send me money. Like, well, I need you to send money to your account so that way I could buy Apple for you, so we can start the position for Apple because that's her favorite company. So I'm like, you need to buy Apple.
Yeah, Apple.
This is crazy.
Apple's first stop, 171. Apple's true stop, like where I think based on like how violently this thing broke. Mm-hmm. I'm saying 158. I'm saying 150, 160. I'm saying this.
Hey man,
this gets
my calculator's saying the same thing. My calculator's saying like what, 145 to 166, 168.
And so if you look at the volume on Apple, that's the get out of town, get out of Dodge, quick volume. That's not something that's like. It's you got a gap, you got a rejection at the 50, next stop 200 daily. And everyone that's a bull out there probably saying, no, Apple's going to new all-time highs. You said the same thing before it went to 130. So guess what? I'm going to stick to the track record.
And if it falls down to 130, I'm going to be a lot more aggressive with Apple. I really, really am. Because I'm just, it is what it is. But I think that's what pretty much is going to end it here, guys. If you like, comment, subscribe. It really does help with the algorithm on YouTube as well as Rumble. Next week, we have a lot more earnings as well. We're probably not going to do as many live streams. Again, I'm so sorry I couldn't live stream on Friday. That was on me, not on him. I know we always like to blame the TA guy, but that was on me. But next week, we do have a few more days, a lot more days of earnings. We're probably not going to live stream as much as we just did last week. We might do maybe one or two.
We'll definitely do the
three.
CPI report and then maybe
Right. We'll do the CPI report and we'll do any big companies that may be in between those days. But we're not going to do it as frequently as we just did these past 2 weeks. Regardless, though, earnings is still going on. It's still crazy. And I guess we'll see what happens. We'll see what happens. So with that said, peace out, and we'll see you all next time.